The exchange rate for a currency is determined by the supply and demand of that particular currency in the Forex market. The supply represents the number of assets that are available to be bought, and the demand is the quantity of that asset that people are willing to buy. When there's a greater demand for a particular currency than the supply, its price will increase as buyers outbid each other. On the contrary, when there's more supply than demand, the price decreases. The charts show this constant exchange of orders that happens all day long. The charts usually show balanced transactions until you see some big imbalances. The spikes you see in price are made by large institutions placing orders in the market. So it takes massive amounts of money to move a single pip in the market. So as you may already know, you and I are not able to make the waves in this trillion-dollar ocean. We need to wait for these waves of orders and catch them when it's time. These orders are placed at key levels in the market. So our job is to find and map where the big players are placing their orders so we can use them as point of interest. Just to recap what I mentioned in the supply and demand overview section, which is really important to understand supply and demand mapping. So first, there is a constant exchange of orders between buyers and sellers. The imbalanced spike of orders is generated by large institutions that use a combination of fundamental and technical algorithms to decide on the strength of a currency. Based on all of this information collected, orders are placed on the market which leave traces and can be clearly visible on the charts. We always need to have in the back of our mind that for price to move, orders need to be filled. So whoever is placing these orders are always looking for liquidity in the market. They need to use liquidity to fill their orders to make the market move. When looking to map strong zones, we're looking at places where price previously reacted to a zone, also called the flip. There was a breakup structure, had a liquidity sweep or inducement, which we will go over in the next lesson. We will be using the flip analysis in all of the time frames, including on the 1 minute for entries. So it's very important to understand this concept as well. A flip is a reaction to an important resistance level that will lead to the price breaking through or reversing from it. So if the price just breaks through a level without reacting to it, that means that the zone is not important enough, so we don't need to map them. So if sometimes you see me marking a zone and then later I delete it, it's because it's unnecessary to leave those zones on the chart because there was no reaction to it. As I mentioned before, we use multi-time frame analysis to understand the bigger picture of the charts, but it can also be used to spot strong zones. First, let's understand the basics of multi-time frame. So 1 week candle equals to 5 daily candles. 1 daily candle has 5 4-hour candles and so on. So when mapping our zones, we also start painting the picture from the higher to small time frames. It's similar to the Russian stacking dolls. We will map zones inside of the zones until we find our precise point of interest. For example, we will map 1 daily candle zone, and when we drop to the 4-hour time frame, we can refine our zone to a more specific area. And as we start looking at the 15-minute time frame, we can spot a range that simply means that there's been an accumulation of orders. And inside this range, we'll be able to refine even more our zones to create our entry areas or points of interest. With the multi-time frame zones in mind, let's see how we can start creating these zones. So again, what are we looking for? Reaction zones and zones that break structure. These zones will be seen on the charts in form of a single candle, which can also be refined to body and wick or just wicks, depending on the size, in sidebars, and buy to sell or sell to buy ranges. These supply and demand zones can be seen everywhere in the market, so mapping the right zones will also be a skill you'll get it with time. You will see that if you mark every single zone on the charts, it will make your charts look like a war zone and probably get in the way of you making the right analysis. So it's our job as technical traders to find which one of these zones makes sense to create a trade idea around it. We need to gather all confluences in our favor, like trend direction, Is the price reacting to the zone for a continuation or a reversal? Discount or premium areas, where is price related to structure? And most importantly, liquidity. So next, we'll explore the liquidity theory and its application in refinery zones.